Hello, good day to you. I welcome you to my channel again. Thank you for being part of it at this particular point in time. Today we're looking at a very important topic in accounting. We're talking about partnership accounts, basically, and then we're looking at the introductory aspect of it, this particular moment. I would like you to subscribe, to share, I would like you to comment, whatever it is that you get to hear and learn about the topic this for this particular moment. So let me just share my screen so that we can just start. All right, just a moment. Then put it in the presentation mode. Yeah, so here we are. So we're looking at financial accounting, and then the topic basically is partnership accounts. And like I said, we're talking about the introductory aspect of it today. My name is Dr. Bafemi Uyewumi. I welcome you once again. So let's look at the objectives. At the end of this lecture, students are expected to understand the meaning of partnership, appreciate the types of partners and their respective features. That talks about the fact that partners are different types of partners and then they have their respective features. Know the meaning and contents of partnership deed, appreciate the types of capital structure in partnership accounting, and then understand the appropriation account and its usefulness. So those are things that you're expected to learn at the end of this particular lecture this hour. So let's talk about partnership accounts. Okay, what is the meaning of partnership? When we say partnership, what are we really referring to? All right, a partnership arises when two or more persons or people co-own a business and share in the profit and losses of this business. So everybody, one or two, and more than two, more than one person, I rather is more than one person, where two or more people, where they come together, to co-own a business. So everybody has a share in the business, okay, has a particular portion of ownership in the business. So that's when we talk about, a partnership. Every partner contributes something to the business. It could be an idea, it could be money, property, it could be assets that you're bringing in into the business, maybe your goodwill, maybe your connection, that's what you are bringing to the partnership. All right. The partnership exists where two or more persons carry on the business in common, a business in common for the purpose of profit making. So when you're doing this, you're doing for the purpose of making profit, So basically, that's why partnership exists. So it's an association of two or more persons engaged in a business enterprise in which the profit or losses, okay, as the case may be, are shared proportionally. Okay, so when two or more individuals engage in an enterprise as co-owners, this organization is known as a partnership. It's not a limited liability company. All right. So in most cases, when you see this type of structure, when you see that kind of business organization or enterprise or entity, you see that they don't mention LTD, they don't say limited, at all. It is either and co, associates, and things like that. It's really referred to as a firm, in some cases as well. So a partnership is a business run by two or more persons who agree to contribute assets to the business and share in the profit and losses. So this organization is popular among personal service enterprise, such as the legal and the public accounting, profession. So that's talking about the meaning of partnership. So let's look at different types of partners. First, we have general partner. Who is a general partner? This is a partner that's actively involved in the management of the business. General partner is actively involved, is from A to Z, involved in the business of the management of the business of, of the partner. I'm talking about the partnership now. Such a partner has unlimited liabilities. That's just what structure says. It has unlimited liability. So whenever there is a debt, or whenever there is if the business should run into debt, then of course it has unlimited liability. Okay, and what does that mean? It means that yes, he's personally liable. He assumes full responsibility for all the business, for the partnership of business debts and obligations. So he cannot delegate, he cannot carry it, he cannot take it to somebody else. So everything that he has has to use it for the purpose of settling such a debt. So the second one is a limited partner. who is a limited partner. This type of partner does not participate in the management of the business. So he does not participate in the management of the business at all. Okay, his liability, that's why it's called limited. His liability is limited to the amount of capital invested, into the business. It's limited to that extent. So a limited partner is that whose personal liability is limited to the amount of his or her business investment. Once that particular amount of money is used or maybe lost or used to take care of, that's the end. He's not going to be required to bring out money from his own personal purse to settle the business or the debt of the business. The third one is sleeping or dormant partner. Sleeping or dormant partner. This is the type of general partner who does not participate in management of the business, but nonetheless has unlimited liabilities, just like any other general partner. So those are the types that I'm limiting it to. We have other, it's possible for you to see other partners being mentioned in books, okay, but of course, limited to these three. Basically, everything, revolves around these three partners, these three types of, partners. Let's look at partnership deed or agreement. When we talk about partnership, what are we referring to? It's a written agreement that guides the formation, operation, and the dissolution of the everything that has to do with the partnership must be recorded or stated, in the partnership deed. It's an agreement. We say that when it comes to partnership, two or more persons coming together to co-own a particular business entity. All right. So usually it comes with an agreement. An agreement will define the formation, will define the operations, will define the dissolution, will define, maybe admission of a new partner. Anybody that just comes into the partnership, we will define everything as much as possible be captured, within the partnership agreement. All right, everything that has to do with the operation will be captured in partnership agreement. A partnership deed, also known as partnership agreement, is a document that outlines in detail the rights and responsibilities of all parties to a business partner, to a business operation. So all the rights, the responsibilities of all the parties, of all the partners now will be taken care of, will be, well explained and documented, in a partnership agreement. It has the force of the law. That means that once it's entered and signed, then it has the backing of the law. So no partner can now say that, oh, I'm no longer interested, or rather, yes, it's possible for you to say I'm no longer interested, as defined. Of course, there will also be some procedures. If you are going to exit, if you are going to leave, there will also be some procedures that will be stated what happens if you have to leave. Okay, so what I'm saying here is that it has the force of the law. So it means that it's a document that law recognizes. Okay, it is helpful in preventing disagreement over the role of each partner of the business and the benefits which are due to them. All right, so let's look at the contents. What are the usual contents of a partnership deed or agreement? Let's look at some. So usually covers areas like the nature of the business. So to be well stated, what are we going into? What are we doing? The nature of the business will be well spelled out. What are we buying? What are we selling? What are we doing? Is this to render service or is this to, connect? Whatever it is must be stated. The types and numbers of partners too must be stated. The types and number of partners must be stated. How many partners are we going to have? Maximum. Okay, for example, are we just going to have two? Are we going to have three? What happens, if somebody leaves or somebody dies? It must be stated. The duties of partner too must be stated. Okay, if you're a general partner, what are you supposed to do? What are you not supposed to do? The share capital to be contributed by each partner will also be, stated. Okay, so it is expected that all this is captured in the partnership agreement. The rate of interest to be charged on contributed capital, if any, in the event that the partners will earn interest based on the capital that they have brought into the business, apart from share of profit, it must be stated. The rate of interest on loans must be stated. The rate of interest on drawings by the partners will be stated. The salaries to be paid to any of the partners, if any, too, will also be stated. What will be the basis for sharing profit or losses, as the case may be? So it must also be stated. What's the condition for retirement? What's the condition for admitting a new partner? It must also be, stated. Okay, so these are the areas that will be covered, okay, in a partnership, agreement. It's expected that a partnership agreement will detail out all these areas so that, like we said earlier on, it will it has a way, that's it helps to reduce conflict. It helps to, dissolve, disputes as much as possible. So all of this will be detailed out in the partnership deed or partnership agreement. So let's look at where we are really going here. Let's look at the capital, accounts of limited liability company. Okay, let's look at the account of a limited liability company. A separate capital account is open for each partner, okay, to show his investment in the business, okay, to show his investment in the business. Okay, and there are two types of structure. There are two types, there are two structures there. Number one is the fixed capital account and the fluctuating capital account. So under fixed capital account, what are we talking about now? Under this method, the capital invested by the partners remain constant unless additional capital is brought in or some part of the existing capital is withdrawn permanently by agreement. So in the event that the partnership agreement allows, partners to withdraw, usually it does not happen like that. But in the event that, yes, the partnership agreement, talks about the fact that you can withdraw, your capital at any particular point in time, so be it. So in this particular case, when we talk about fixed capital structure, we're saying that as much as possible, the capital invested by the partner will be maintained. It has a different account maintained for capital alone and remains constant unless additional capital is brought in or added, or the one that you have there is removed. All right. All other transactions relating to drawings, interest, capital, salary, commission, part to the partner's share of profit, and also, and the likes will be recorded in the current account. So that means that when we talk about the fixed capital structure, there will be capital account, then there will be current account. So that's what we have here. Okay, the two accounts are maintained. Okay, two accounts are maintained, in the books of a firm, capital account and then the current account of the partners. All right, so that's fixed capital structure. Let's look at what the structure looks like, the next slide. Let's go there. So here we are. So we have capital account and then we have the current account. So in the fixed capital structure, we have capital account and then we also have current account. You can see that on the debit side, all right, you have the particulars, you have the bank or cash for withdrawals. If there is any room for you to withdraw or for the partners to withdraw, be recorded. And then if there's, of course, on the credit side, you have the capital account structured. We are talking about the different partners now. Okay, here we have partners A, B, and C. So the capital structure is maintained here. Balance brought down. Okay, see the balance brought down there. Capital, cash, or bank introduced. So in this case, now it means that partner B introduced a particular amount of money in the course of the year, and then you have the total, and then you have the balance, carried down, as the case may be. So you have current account. Now the current account takes care of all other transactions between the partners and the business. Between the partners and the business. So you have the balance brought down, and then in case it's possible for us to have a debit and credit depending on maybe somebody has overdrawn his account. So it's possible to have a balance brought down and then have at the same time the balance brought down on both sides. But of course, when you have balance brought down for A, you will not have it for on the other side, for A. So I want to admit that yes, this one should not just be entirely like the way it's stated. Okay, please have that understanding. So we have drawings. Okay, then we have interest on drawings. We have PLN appropriation. Okay, so in the event that yes, when you appropriate your P&L, okay, we're going to talk about appropriation later. When it results to a loss, then what happens is going to have a debit, entry here, and then all the items, all the accounts, all the monies due to the partners are stated on the credit side. Okay, interest on capital, salary due, commission, and then where you have profit and loss appropriated. Okay, that is profit. I mean, talking about profit now, then of course comes to the credit side of the divide here. So that talks about fixed capital structure. Let's look at the next one, which is fluctuating. Under this method, only one account is maintained. One capital account is maintained. All the entries relating to drawings, interest on drawings, interest on capital accounts, salary, commission, profit or loss, the share of it, okay, are recorded in the capital account. Everything will be in the capital account. everything will be recorded in the capital account. So whether it's capital, okay, whether it's interest, drawing, whatever it is, will now be taken care of in the capital in one account, unlike the one that, or the other one where we had, capital account separate and then the current account as a separate, account. So that talks about the fluctuating type of structure. Let's look at appropriation now. Appropriation account. This is a distinguishing factor. Okay, this is a distinguishing factor between between the sole proprietorship and partnership business. Okay, the appropriation account is an additional account statement that is required for partnership. Usually, what you have your for a sole proprietor, for a business owner, for maybe an entity that has to do with an individual. Okay, what you have is just for you to have is your normal what you say P&L account or income statement. As the case, now it's income statement. All right. So you have an income statement where you have your sales, you have your cost of sales, and then you have your gross profit, and then you have all your expenses, and then you arrive at what? You arrive at the net profit. So that's what's been done on the normal, in the normal accounts structure for a firm, for a company. Okay. But now in this case, the income statement will not, just end the way it usually ends for sole proprietors. Okay. What happens? There's been an extension, and the extension is what we're capturing as the appropriation account. So it's an additional account, okay, that is required for partnership. So for a sole trader, the profit is simply transferred to the credit side of the proprietor's capital account, and that will put paid. That will end the whole transaction or end the whole accounting structure or framework. Now, when it comes to partnership, the income statement will still be debited, but the profit is credited to the appropriation account, which is an extension of the income statement. So the appropriation account is maintained to show how the profit is or loss is being shared to the partners of the business. So there will be some appropriation, we call appropriation items that will now be considered in the appropriation account. Okay, the appropriation part of the account. Okay, so let's have an idea of what we talk about here now, relating to what those items that will be brought into appropriation account. Number one is partner salary. Partner salary. So salaries of business usually, okay, is an expense, and they are written off to the income statement. Okay, it helps one way or another, it reduces the profit for the year. Okay, but in the case of partnership, partners are owners of the business. So when they take profit or when they take salary, it is assumed that they are actually sharing in the profit of the partners of the partnership or the business. So what happens? It means that such an amount of money or whatever it is that they're sharing will not be taken ordinarily as a business expense, but will be taken as an appropriation item. So this amount, because it's guaranteed, because it's coming to the partner, okay, because it's also going to, affect the residual amount of money to be shared at the end of the day, will now be taken to the appropriation account. So the entries to be made, you have to debit the appropriation account and credit the respective current account of the partners. That is for partners, salaries. I believe that you get that analogy and that understanding right now. So salaries of partners will be taken as an appropriation item. So let's go to the second. The second one is interest on capital. We're talking about appropriation items now. Okay, interest on capital. This is interest on capital to be paid on partners' capital balances. So what we're saying here, that if the agreement says interest will be paid on the outstanding capital balance or balances, for all the partners, then they will also be calculated appropriately. Okay, so how do you bring it to the system? How do you bring it to the account? It also be brought in as an appropriation item. So after arriving at your net profit, okay, and you come down to the extension, the extended part of the income statement, then you have interest on capital to be appropriated. Okay, so the business is the one that is paying. So what do? You debit the appropriation account, and then you credit the current account of the respective partners. That's just what it is. So paying interest on capital is a means of rewarding partners, of course, for investing extra funds into the business, as opposed to alternative investment. So alternative investment could have been for you to go and source for loan, or from maybe a commercial bank or whoever. All right. So when a partner brings in extra money to say, I am investing, this money into this particular business, so please, I need to get, maybe a reward. So it has a way of reducing, the profit at the end of the day, the profit available for the partners to share. Okay, so these are the entries to be made. Now, what's the next one? Interest on drawings. Interest on drawings, that's the next one. So whenever drawings are made by partners, it is expected that interest will be paid by the partners. Drawings now talks about a partner coming to the business to take part of, maybe to draw cash out of the business. So whenever drawings are made, it's expected that interest will be paid. So this time around, it's the partner that will be paying the interest. Okay, it has a way now of increasing whatever it is that will be shared, to the partners at the end of the day. Okay, so why do we have to charge interest? So charging interest on drawings is a means of discouraging partners from withdrawing excessive amount from the business. So we have the entries: debit partners current account. Remember now, current account. This one talks about the fact that yes, we're maintaining fixed capital structure, and then credit the appropriation account is coming in as an extra money to be shared. So the different partners. So let's look at what I call the final note. On the final note, the aforementioned appropriations are to be dealt with by sharing, or dealt with before sharing the residual profit between the partners. So at the end of the day, every partner wants to collect or want to take, profits that have been made by the business. Okay, so all of these items that we have mentioned, okay, will have to be dealt with before they share of profit to the partners. If the total of the appropriation is greater than the profit for the year, of course, we know what it means. It means that the amount to be shared will be a loss. They're sharing a loss, because that means that you don't have anything to share, basically. Otherwise, as a matter of fact, you are sharing a loss. Okay, so the entries for the share of the swap profit will be credited to, will be a credit to the appropriation account, thus resulting in a nil balance, and the debit, in the partner's current account, and vice versa, as the case may be. So if there is a loss, then of course, what do you do? You're going to, debit the appropriation, and then credit. If there's a loss, that you're going to debit the partner's current account, and then credit the appropriation account. Okay, that talks about the final notes, in this particular matter. Okay, let's go to the next slide, which is almost like bringing the whole thing to an end right now. So I said the entries for the share of residual profit will be a credit in the appropriation account, thus resulting in the nil balance, and then debit the partner's current account, and vice versa for the share of loss. So let's go. Interest on loan. This is very, very critical. You have to take note. Interest on loan from a partner is regarded as a business expense. So it's not an appropriation item. If a partner should bring a loan into the business, then it's an expense. It's not going to be taken as an appropriation item. So it will be taken to the profit or loss account or the income statement as one of the expenses to be deducted from the gross profit in order to arrive at the net profit of the partnership or the business. It is not going to be taken as an appropriation item. So that's just what we have today to cover. We're talking about an introductory aspect of partnership account. The next time we have, a class or a lecture, we're going to be solving some, some questions, illustrative questions, so that we're able to have proper understanding of how accounts of a partnership, are being maintained. So I believe that you have learned one or two things, from today's class. I implore you once again to subscribe to my YouTube channel, and then of course, if you want to make some comments, go ahead and do that. If you want to share this particular video as well, just go ahead and share, so that others too can also benefit from it. Thank you for being part of it, the class, today. I definitely, when you subscribe, you're going to see any notifications. Whenever I drop um a new lecture, a new video, you'll be able to see the notification, and then you'll also be able to participate, as much as possible. So thank you once again for being part of it.